Innovative ideas, emerging trends, industry insights. We're connecting with Conning on RIN TV. Continued low interest rates and bond yields present challenges for insurers that rely on high-quality investment yields. So what are the options and are they secure enough? Here to discuss insurance investment options is Michael Haylon. He is Managing Director at Conning and joins us from Conning's headquarters in Hartford. Mike, welcome to the program.
Thanks for having me.
So Mike, as we all know, interest rates have been low for quite some time. Bond yields not much better. How has that affected insurance investments?
It's created some major challenges for insurance companies. Many companies had built into their forecasts increases in bond yields this year and last year. It just hasn't happened. But it's not only been the fact that treasury yields have remained very low, the yield spreads on the kinds of instruments insurance companies typically invest in, like corporate bonds and mortgage-backed securities, those yields have dropped much more dramatically than those of treasuries. As a result, portfolio yields are continuing to decline. Portfolio yields for insurance companies last year in many cases were at record lows. And as bonds and existing portfolios mature and the proceeds have to be reinvested at lower rate levels, it's going to continue to create more pressure for insurance companies over the next few years.
What investment strategies have been working best for insurers?
Well, really, we've been in a risk-on environment. The companies that have taken the most risk, the most credit risk, and the most interest rate risk have really been the ones that have been rewarded. If you look within the bond market, high-yield, below investment-grade bonds have dramatically outperformed investment-grade rated bonds since the financial crisis in 2009. Similarly, if you look in the investment-grade market, both with corporate bonds and mortgage-backed securities, BBB rated bonds have outperformed single-A and double-A rated bonds. In addition, because long-term yields have continued to decline, the companies that have taken the most interest rate risk and have extended out the yield curve have been rewarded. So companies that have taken the most credit risk and the most interest rate risk have been rewarded. However, we're not convinced that the strategy that's worked so successfully in the last 5 years is necessarily going to be the most rewarding strategy for the next 5 years.
The Fed keeps hinting at increased interest rates. How is that changing the outlook?
Well, we think it's not going to change the outlook too dramatically. The reality is that any increase in short-term rates, and we do expect rates increases in 2015, is likely to be relatively measured. Rates will remain quite low by historical standards. In addition, if you look at yields on U.S. bonds, they continue to look very attractive relative to yields in many foreign markets, particularly relative to yields in Europe, which have dropped dramatically in recent months because of the quantitative easing that's been enacted by the ECB. So we think any increase in bond yields is likely to be relatively modest.
Where else can institutional investors go for better returns?
Well, we see a couple of attractive opportunities. One is in emerging markets debt, which is an area that's really been not focused on to any great extent by insurance companies in the U.S. In fact, less than 1% of invested assets among U.S. insurance companies are invested in emerging markets debt. The reality is, many years ago, emerging markets countries experienced a lot of volatility, and it was a pretty risky area for many bond investors. But many of these countries have implemented meaningful economic and fiscal reforms. They've improved their budget deficits. They've lowered their debt profiles. Over 70% of bond indices, the emerging markets bond indices, are now rated investment grade. So there's been dramatic credit improvement. We also like master limited partnerships, where we see very attractive distribution yields, particularly for those MLPs involved in the midstream space, storage, distribution, and processing. They get paid based on fees. The fees and volumes are locked in under long-term contracts. We think they offer a very attractive alternative relative to the fixed income market.
And how risky are those investments?
I think you have to look at risk in a portfolio context. And the reality is there's not as much risk as being priced in the market. But one of the concerns we have about insurance companies is our portfolios are getting very concentrated in corporate bonds, specifically in lower rated, BBB rated corporate bonds. We think in a portfolio context, by investing in different parts of the world, in different sectors and different asset classes, can actually enhance risk-adjusted returns and portfolio diversification.
Thanks for those insights, Mike.
Thanks for having me.
For more on investment strategies for insurance companies, visit the Conning website.